Hey everyone, and welcome to today's Explainer. Listen, if you've ever felt completely overwhelmed by the idea of investing, you are absolutely in the right place. Today, we're breaking down a totally jargon-free, three-step framework to help you build your very first real portfolio. Top financial experts actually all have one major thing in common. They keep things surprisingly simple. So let's show you exactly how to do that, even if you're starting from scratch.
But first, we really need to address the elephant in the room here. 9 out of 10 beginner investors make the exact same mistake. They try to pick individual stocks. Look, I get it, it's super tempting to hunt for the next big tech startup, but guessing on single companies is pretty much exactly how most people lose their money. It's a trap, and it's exactly the trap we're going to help you avoid today.
So here's our roadmap for today's Explainer. Step 1, the shopping basket. Step 2, time is money. Step 3, automate to remove emotion. And then we'll wrap it all up with a definitive 3-step portfolio guide.
Okay, let's dive right in. Step 1, the shopping basket. Basically, what should we actually be investing in? Think about walking into your local grocery store. Buying an individual stock is a lot like buying just one single apple. If you drop that apple on the way home, or if you bite into it and it's rotten, well, your whole snack is totally ruined. That's the high risk of stock picking. But instead, what if you bought a massive shopping basket that automatically holds hundreds of different apples from farms all over the world? If one happens to be bad, it really doesn't matter, right? Because the hundreds of others are still perfectly fine, holding the overall value of your basket up. Buying the whole market is just infinitely safer and smarter than betting everything on a single company like Apple or Tesla.
In the financial world, that giant shopping basket is called an index fund, or an ETF, which stands for Exchange Traded Fund. It's simply an investment that automatically holds and tracks hundreds of global companies all at once. It gives you instant diversification. You literally don't need to be a Wall Street genius trying to pick the winners because you just own a tiny piece of everything. This basket approach, it's exactly how the smartest investors in the world achieve steady, reliable growth over time.
Moving right along to step 2, time is money. This is where we figure out risk and your time horizon.
I want you to be brutally honest with yourself for a second. If your portfolio dropped 20% next month, would you panic and sell everything? Your answer to this hypothetical tells us everything we need to know about your true emotional capacity for market fluctuations. This is what the pros call your risk tolerance.
Look, if a 20% drop makes your stomach absolutely churn and you just know you'd panic sell, that is not a weakness. It just means you have a lower risk tolerance and you need the stability of bonds. Bonds are essentially just loans to governments or corporations. They grow slower, but they act as a stable buffer when the markets get really choppy. On the flip side, if you're thinking, I don't care, I'm investing for 20 years, well, then you have a high risk tolerance. You can harness the serious growth engine of stocks, which represent actual ownership in companies and offer way higher growth, even with their short-term ups and downs.
So the absolutely crucial point here is figuring out your timeline. When do you actually need this cash? Let me give you a crystal clear rule of thumb. If you need the money in less than 2 years, like say for a car repair or a vacation, leave it in a high-yield savings account. Do not invest it. But if you don't need that money for more than 5 years, you should absolutely be investing it.
Let's actually look at the math behind your time horizon, because this is wild. Say you invest just $200 a month at an average 7% return. If you start when you're 22, by the time you're 60, you will have over $500,000, $500,000. But what if you use the exact same money and the exact same discipline, but you wait until you're 32 to start? You end up with only about $240,000.
Actually, let's let that sink in. That is a $260,000 difference. Waiting a single decade to start investing doesn't just cost you time. It literally costs you hundreds of thousands of dollars in lost compounding interest. This is exactly why young people with a small budget shouldn't wait. You might not have a ton of cash right now, but you possess an asset that is insanely valuable: time. Your long runway means you can easily ride out those short-term drops in the stock market.
All right, bringing us to step 3, automate to remove emotion, and how to start small.
The ultimate secret weapon for beginners is the magic of automation. You don't need thousands of dollars to get going. Most platforms today let you start with just $10 or $20 a month. By setting up an automatic monthly deduction, the investing simply happens in the background. It completely bypasses that panic of wondering, oh, is the market down today? And it totally prevents you from skipping a contribution just because you had a tough month. Essentially, it removes human emotion from the equation entirely, which is great because we are often our own worst enemies with money.
And let me tell you, this is incredibly empowering. especially if you're a student or young professional on a really tight budget. $50 a month invested consistently will beat $5,000 invested once and forgotten every single time. Consistency is literally the entire game here. You don't have to wait until you have enough money. You just have to start the engine and let it run automatically.
All right, let's bring it all home. The 3-step portfolio guide, putting it all together.
Here is your definitive summary. Step 1. Pick one low-cost global index fund or ETF. Just find something that tracks the total world market with an expense ratio below 0.20%. Step 2. Use your massive time horizon. If you're young and have 30-plus years until retirement, you don't need a super complex mix of bonds right now. You can just focus on pure stock growth. Step 3. Automate a monthly contribution no matter how ridiculously small it feels and leave it alone. That's it. That's the entire system. One global fund running on autopilot.
At the end of the day, the best portfolio isn't the most complicated one. It's the one you actually stick with. Remember, you possess an asset right now that millionaires would gladly pay top dollar for, and that is time. Every single day you wait is compounding interest lost forever. So seriously, what are you waiting for? Drop a comment below with the age you're starting your investing journey, and be sure to check out our other explainers for more market deep dives. Thanks so much for joining me today, and happy investing.